So in this week's video, we're going to be looking at this question of how many customers can my product ultimately reach, and how much value will customers receive from that product when we reach them? And, there are lots of different ways to kind of introduce this topic, but one of the things people often ask venture capitalists is, well, what's the most important thing you look for in an investment? And, there are lots of answers to this. I will just tell you my bias as an investor here is that it's never just one thing. You have to remember the bias of venture capitalists is to say no, not to say yes. And so it's not that if one answer is really great and all the other answers are terrible, that you can still get a deal done. The reality is you need to have a great deal along lots of dimensions. But Tim Draper had a great answer to this when asked what's the thing he looks for. He says, ultimately, the thing he looks for is what we're talking about today, the market size. How big will the company become if it took the entire market? Now, obviously, this is more of a thought exercise. Even in businesses that are so-called monopolies, using the Peter Thiel language, they don't ultimately take 100% of the market. But many markets do operate in a winner-take-all phenomenon today, and certainly it's a helpful thought exercise to understand the order of magnitude opportunity if the business is successful. And when you're doing this, you want to answer the question really along three dimensions. The first is just the overall universe of customers who your product or service could support. Then you can take a subsegment of your total addressable market and look at, okay, well, with your current sales and marketing channels, who could you attract? And that's your served available market. And then who are your likely customers? Those are your target market customers. And you can, with the visual on the screen, see here how each of these kind of gets smaller and smaller as you move from total addressable market to served available market to the target market. And just to give you one example, this is an older example. This is over 10 years ago, but the Lightspeed venture capital firm published this example years ago. And while the example feels a bit dated in some ways now, I do really like the visual. I think it does an excellent job showing how you can kind of think about a set of assumptions top down to drive to a market size. So this is a product called Vigilink, which ultimately was sold, but Vigilink was a product that helped people publishing content on the internet add affiliate codes to those links. So if you didn't already have an affiliate code on the link, you could use this service to append it, and then they would share the revenue. So you drive traffic to a place like Amazon. Sometimes when you get to that page, you already have an affiliate code on there, and Amazon will share the revenue with you if that results in a sale. But sometimes you forget to add that. Vigilink would add that to it, and then they would share the profit. And you can see how here they start at the top level looking at overall global versus US e-commerce sales, and then they walk through a set of assumptions to understand, okay, well, what really is the total addressable market for our product today? And if you think about it, you can imagine different filters, whether you're talking about TAM, SAM, or your target market, right? You may, for example, for your total addressable market, include not just e-commerce sales in the United States at the top, but you also might include e-commerce sales worldwide. And remember, these numbers, if they look a little weird to you, remember this was done over 10 years ago. But we're looking at just how we're starting with big, broad, and then we're slicing it down using each of those slices to make the next segmentation. You do have to be careful when you're doing this. This is a fun story for two reasons. One, it's always fun to joke about McKinsey, but two, it does point out that sometimes these are harder to assess, especially when you misdiagnose exactly the problem that your product is solving. So famously, in what I would often describe as at least the most economically, maybe not societally expensive, but the most economically expensive McKinsey project ever, McKinsey was hired by AT&T to predict the size of the cell phone market. And as you can see here on the screen, they completely missed the boat by orders of magnitude. And ultimately, AT&T would not need to spend billions of dollars to buy their way back into the cell phone market, making this, again, the most expensive economic McKinsey project ever, given it cost AT&T ultimately billions of dollars to have outsourced this question to McKinsey. The other thing that's important beyond sort of misdiagnosing the problem that you solved is that sometimes your initial set of customers is not your ultimate vision. And I think about this two ways. One, sometimes your initial target market is really just a beachhead to expand out. And sometimes there's a second revenue model. So even if the number of customers remains the same, the revenue per customer changes as well. And I call both of these things second wave estimates. And so coming back to this first type, sometimes you want to start by focusing on a niche and then expanding out. So Tesla starting with high-end sports cars, Facebook starting with Ivy League students, LinkedIn starting with Silicon Valley entrepreneurs. That was not the ultimate total market that was available to them, but it was how they got started. And then sometimes how you monetize your business in the beginning is not ultimately how you monetize it. So there are these additional monetization streams of your customer base that need to be taken into consideration. This is incredibly popular today with a lot of SaaS businesses that may start as a classic software as a service business, but add in marketplace revenue or payment transaction and margins on those transactions. But both of these, this additional monetization and this focusing on a niche and expanding out, they're both examples of this second wave estimate. And so with that, hopefully now you can have a better answer when someone says to you as a product leader, well, how big really is the opportunity that your product is servicing? And you'll see in the next video why this becomes incredibly important when thinking about valuation.